paper coverage is not the same as fundamental coverage is very, very interesting. I've used the example before that it can be all nice and well that you have all these wonderful pounds and all this fuel cycle material on your balance sheet, but if you then try to put that piece of paper into a reactor core, it's not going to go well. It's not going to produce any power, and then you have a multi-billion-dollar asset that is just going to be sitting there idle. That will, of course, never happen. They will always go out to procure the sufficient amount of uranium and fuel cycle material that they need. Paper coverage is not the same as fundamental coverage is very, very interesting. I've used the example before that it can be all nice and well that you have all these wonderful pounds and all this fuel cycle material on your balance sheet.
Hello everyone and welcome to another edition of Triangle Investor Interviews. I'm your host Lucian Valkovic, and before I announce my guest, just a reminder of a disclaimer. This interview and all my interviews are not a recommendation to buy or sell any shares, products or services. Always do your due diligence and consult with your financial advisor. My guest today is Mart Wolbert. We all know him as a yellow bull from X. Mart is a founder of Contrarian Codex, which is focused on macro, uranium and commodities. My dear friend, welcome to the show.
Thank you for having me. It has been far too long since we last spoke, so I'm glad that I'm able to do interviews again. And of course, you had to be one of the first that I spoke with.
Thank you very much. It has been a while, and we have a lot of things to cover today. But let's start with the WNA Symposium, which took place in London recently. We returned recently. What was your overall impression of the atmosphere and the sentiment on WNA Symposium you attended, and how would you compare it with the previous ones, with last year and the year before?
It was great. I've been going to these symposiums for several years, and also several other mining and uranium related conferences, and we were talking a little bit about it off air, but we both agreed that this was perhaps, or actually very clearly, the best symposium that we've been to date, because it was not only was it very, very informative, like it is every single year. Like the guys over at WNA, they do an exceptional job organizing these conferences. But the fact something that made it extra special was that it came against a backdrop of so much positive nuclear power related news. And I spoke to several industry experts on the nuclear side of the equation, who were basically over the past few years, and especially 5 years and beyond that time frame, nuclear was kind of seen as, okay, well, nuclear power is bad and it's a dying industry, yada yada yada. You've heard it all before, but right now, they're getting inbound calls from people that didn't really believe in nuclear power before, that are seeing kind of that shift in viewpoint, and I think that is really, really significant. So it coming off the back of so much positive support is great. The fact that it is a fuel report year made for some very interesting conversations. And overall, as I've described it before, I would describe the conference as a shift in mindset. So over the past few years, you've already seen the regular parties, if you want to call them that, some analysts, some hedge funds, the producers who were bullish on uranium, who were bullish on nuclear power, and then you had people that were perhaps more conservative on a relative basis. But what you're seeing right now is that pretty much across the board, you saw super, super positive views on nuclear power, and also across the board, you saw at least some form of concern regarding getting enough supply out there, not just uranium, but across the entire nuclear fuel cycle. And I think that shift in mindset was very, very clear to be seen. And I thought that was super interesting. So speaking to people from across the industry, and drawing that conclusion, it really put a smile on my face, because I think that a shift in mindset is needed before fundamental change can happen. And I think that we are just on the cusp of seeing a lot of fundamental changes take place across the industry.
Yeah, agreed 100%. I couldn't say it better than you. Mart, what was the most valuable takeaway from the symposium, whether it was a specific discussion, connection or insight?
I think the most interesting conversation I had, and it's hard to pick because I spoke with a lot of super smart people, super plugged in people, but I think the most interesting conversation I had was with the fuel manager of one of the largest US utilities. And I don't want to rehash the entire conversation here, but basically the three conclusions that we drew from it was, firstly, paper coverage is not the same as real coverage. And what he meant by that is basically that all these contracts that can be signed with these smaller scale producers, these up and coming promising developers, but they are developers for a reason, they still need to get their mine online. Basically what he meant is that all these pounds that they were signing into contracts into the later part of this decade, and especially into the 2030s, it brings with it some degree of uncertainty. So the fact that he very clearly stated that paper coverage is not the same as fundamental coverage is very, very interesting. I've used the example before that it can be all nice and well that you have all these wonderful pounds and all this fuel cycle material on your balance sheet, but if you then try to put that piece of paper into a reactor core, it's not going to go well. It's not going to produce any power, and then you have a multi-billion-dollar asset that is just going to be sitting there idle. That will, of course, never happen. They will always go out to procure the sufficient amount of uranium and fuel cycle material that they need. But the fact that he was saying it so clearly, I thought was very interesting. He also noted that from his observation, and he has done a great job. Like, I don't want to name any names here, and I'm not going to, but he has done a great job at getting his utility ready for the facing of a supply-demand gap. Like, this utility is very well covered, and I complimented him on this as well. And I asked him about the longer-term vision that they perhaps had, and he noted that more and more US utilities are shifting from what was previously a more shorter-term vision, perhaps against a backdrop of ample supply, but also against a backdrop of just a less positive backdrop of nuclear power, if you want to call it that, compared to now, where you see a tsunami of just perhaps tsunami is not the right word to use when talking about nuclear power, but like a complete shift in their vision going to longer term, because they're getting their public, their political, and that monetary support to keep their reactors online, to have a visible sideline running these reactors to 60, 80 plus years, where previously they didn't have that certainty. A vision of more nuclear power plants being built, which was something we also discussed, and they're very optimistic on that front. So that has to kind of change your viewpoint, right? You have to go from shorter-term vision to longer-term vision, and I think that will translate into longer-term contracts being signed to secure that longer-term vision. And also, I believe that we will see more infrastructure restocking taking place, but we can discuss that more later. Which brings me to my third point, and the third point was basically that he echoed the thoughts of UXC. And UXC, I believe it was at a conference last year, they noted that given the supply-demand gap that we're facing, given that the IEA is also noting that if we don't put money in the ground right now, we will not have any chance to fill the supply-demand gap, so we need to get started yesterday. Basically what he noted was, and I thought that was very interesting coming from this fuel manager, is that the supply that you may need in any specific time frame going out into the late 2020s, into the early, and especially later into the 2030s, might not be there in the time frame and the volumes that you need if you're not adequately covered. And I thought that was really, he said it in a very conservative way, and I completely get that, but it really hit home the fact that they are very aware of that supply, that guaranteed supply may not be available for everyone going forward. And from what I've noticed, also talking to other large US utilities, that this is a sentiment that is slowly but surely really getting into the mindset of fuel buyers. And I think that it is great. Like, these, I want to say, like, these are very, very smart people. They are doing, a lot of them have done an exceptional job. They've been in this industry for decades. And I think that the fact that they are now seeing this mindset shift is very, very significant. There are, of course, some other utilities and some other fuel buyers that will turn out to be the proverbial marginal buyer that will push up the price more. There was one utility fuel buyer, or just fuel buyer in particular, that noted that he doesn't see any reason to be paying more than $60 per pound for uranium, which I thought was funny. I didn't think he was serious about it, but he was very serious about it, and I thought that was interesting, and I think that really hits home that even though we're seeing this mindset shift, it is going at different speeds at different people across the industry. But in the end, I think that the direction of this mindset shift will be all the same.
Yeah, that's a great analysis, and especially the utilities perspective you gave us over here. Mart, you mentioned that the last year's WNA Symposium, the retail investor sentiment was at rock bottom, while institutional investors saw the opportunity. Did you observe any change in this dynamic at the most recent symposium, at this symposium, and how are the groups interacting with the market now?
And that was super interesting. Last year, especially at the last day of the WNA Symposium, like retail sentiment was at the lowest point it had been since, I believe it was the end of 2020, where we saw that bump in price action in 2020, and then it pulled back, and everyone was just like, oh, it was just a bump off the lows of the COVID March 2020 crash. And it took a big hit for sentiment. But since then, I've been tracking sentiment data, and I put that in every single bi-weekly newsletter I write. And it makes for some very interesting reading, because last year, of course, we saw retail sentiment being absolutely shaken down, like nearly depression levels, while institutional level sentiment, they were so bullish, which was very, very interesting. And of course, like that psychological analysis of the market, it can help identify turns. It identified the turn at that point as well. We bought a bunch of call options at that point. Those went up 3 to 4x, which was very, very good. And this year again, what we saw is we saw institutional sentiment at the conference being bullish. They weren't like, okay, this is going to move next week and we're going to be at $100 or $120 by the end of October. No, none of that. But they were fundamentally, structurally bullish. And what I will say with regards to my analysis on sentiment regarding retail investors, the correction that we've seen post-October of last year into the lows, into April, and getting the lowest score I've seen since the March 2020 lows, what I've seen, what I've observed with regards to that sentiment data, was that this past correction we saw into the April lows, it left a lot of scars. A lot of these retail investors and a lot of these just investors in general, like I don't want to single anyone out, but a lot of these investors in general, and I'm not immune to that either, I will happily admit that I am also human. What we've seen is that it left a scar, and a lot of people threw in the towel, and a lot of people after a subsequent move to the upside following the April lows, what we saw was that more and more people were like, okay, I'm just going to cash this in. I'm done with this sector. It's too volatile. It's too uncertain. This thesis is never going to happen. We've all waited for too long. It felt like the straw that broke the camel's back, if you want to call it that. And that left a big dent in sentiment data. And I had to adjust my modeling for that to account for that shift. And that adjustment in modeling has really now shown me that previously, when we saw the rise that we've seen from the April lows and the consistently good price action and the consistently good news flow and like very constructive fundamentals that keep coming into the market, previously, especially post the massive raise that spot did, you would have seen sentiment readings go into the high 80s, low 90s out of a scale of 1 to 100. Right now, we're still lingering in the low to mid 70s. Why? Again, because there are still people that really don't trust this rally, because again, it left a scar. This correction that we've seen was so severe that it really left a lasting impact. And I think that is something that needs to be taken into account. And I think that will, in the end, once this sector really gets going, will drag a lot of people back in. So really shifted the dynamics. And I thought that those sentiment readings were very, very interesting.
That's great. Before we move to the questions about the market cycle, just one question about the symposium. That kind of event often brings together industry experts, financial players, executives. What new connections or collaborations did you form, and how do they contribute to your work at Contrarian Codex?
Well, of course, the conversation with fuel buyers that we just discussed were very, very interesting. And I always like to talk to everyone in the industry, also the people that have different viewpoints, which, of course, makes for, because I want to try to get the best reports out there possibly. Like this WNA report afterwards, I had to distill it down and I still landed at 18 pages. And it got a very good reception, which I'm very happy about. But like all these fuel buyers, large hedge funds, fellow analysts, physical traders, producers, and more. It all makes for a big network of information, a big group of very, very smart people that all contribute, because no one can be an expert about every single part of this market. It's simply too opaque, and it is simply too much information. But like talking to the right people and really listening to these very, very smart guys in various parts of the industry, it can help you piece together the proverbial puzzle that is this nuclear fuel and uranium investment thesis. So yeah, I thought that was super interesting, and I definitely spoke to a few new people. I'm very glad to have spoken to some people I've already met, for example, the Consenable management team, who've done an exceptional job, and being able to speak to them as well made for some very interesting insights. So yeah, no, I think that the WNA Symposium was once again a great information opportunity, but also once again a great networking opportunity.
Yeah, one of a kind when it comes to the networking, agreed. Mart, let's talk about uranium market cycle. You've previously described the uranium market using your stadium model, suggesting we are nearing the end of a halftime break. Can you elaborate on where do you believe we are in the uranium cycle today, now?
I think we've firmly shook off that halftime break. Going after the April lows. I think right now we are getting the game underway again, and I think the most exciting part is still yet to come. And that may sound kind of crazy coming off the back of an $82 term price, a $75 spot price. But the fact that I state this is because I think that once we really see contracting happening, like larger volumes of contract, not necessarily replacement rates, but we can get into that later. I think that once we get that going, I think we will see the best part of the second half. And usually the later part of the second half is the most exciting part in any football match. So I think that once we get into that, I think it will be very interesting. I will still remind people of the end of the stadium model, which is even though if we get into extra time and people will be super excited and the game will be absolutely fire, you don't want to be the last person standing in the stadium while they close up and everybody's already left, because you'll be stuck. And I don't think we're anywhere near that. But I think that the coming... it's hard to kind of put a time frame on it, right? Because this second half, it could take a year, it could take 3 years. It really depends on prevailing circumstances. But I firmly believe that we will make our way to triple-digit uranium over the coming year and a half. And once we get there, we have to look at the facts again. Do we have higher to go? If yes, then the second half keeps going. If no, it might be time to get out and leave the stadium for what it is and see if we can build a new stadium somewhere with new opportunities.
Yeah, I really like that model of yours. It gives some perspective. I believe that people understand the timeline here, but and probably curious, what signals are you actually watching to confirm the transition into the second half?
Term contracting. I want to see more term contracting happening on the utility front to really signal that, okay, it's game on. We're going to see more term price movement. And in the end, of course, the spot price, I'm not going to sit here and pretend that the spot price doesn't matter because it dictates a lot of retail sentiment. It dictates a lot of price movement because that's the most visible price point in the market. But the term price ultimately what really drives the companies forward. And what we're seeing is European utilities going to 75% coverage in 2027 and that then dropping lower significantly. We're seeing US utilities going to 55% coverage in 2029 and falling off an absolute cliff into the 2030s. So I think that is very important. I think it's important to note that UXC analysts project £400 million still needing to be contracted in the term market between now and 2030 and £2 billion between now and 2040. And for anyone listening to this and perhaps not, if you're perhaps not as familiar with the market, I don't blame you. It's super opaque and I completely get that. But if you're listening to this right now and saying, okay, Mart, why the hell are you talking about £2 billion being uncovered by 2040? Why does that matter? It matters because these long-term contracts are already going into the 2030s. And once we get through the coming few years of term contracting, those term contracts go into 2040 as well. So that's when that starts to matter. That coverage will need to be secured over the coming few years. And these term contracts are getting longer. We've seen a few shorter terms RFPs, but I believe that we will see longer term contracts being signed. Again, going back to what the fuel manager said regarding the change to a longer term vision of supply and demand modeling. So I thought that was very, very interesting. And I also believe that it will really drive price, mostly because, of course, there are some pounds here. And I think that we first need to get through this $80 to $90 level. Like I discussed that level with a few very, very plugged in people at the conference as well. And basically what they noted was there are a few producers and developers offering pounds here. We need to churn through those pounds. They are offering it for various reasons, whether they want to secure financing, whether they want to show investors they can secure contracts, whether they want to lock in future cash flow. Could be for any number of reasons. But I think the most important part to take into account is that the most reliable producers, for example, Cameco, they are upping their terms. They are not looking for these $60 floors and $100 ceilings. No, they are looking for high $70 floors and $140 plus ceilings around that mark, at least from what I've heard. So I think that it makes for a very interesting standoff, and I think that once we see those terms being signed and once we see end users and other entities interested in buying or securing contracts, once we see them come in and we see these contracts being penned, I will think that will have a very, very good impact on the market, because simply we need to see more term contracts signed, right? We need it to be signed in order to incentivize enough supply to come online. And we're going to need higher prices for longer for that, because while we're watching 4.6% compound annual growth rates for nuclear power across the world, which then runs to 6.3% CAGR in the upper case scenario of the WNA fuel report, we're not seeing supply really being able to meet that. Even if you bring online all these deposits, you restart all these brownfield mines and you ramp up assets that are already producing, you still cannot close the supply-demand gap. We're going to need new greenfield, and we're going to need to have that incentivized via higher prices for longer.
Excellent point again. Beside the long-term contracting, what are the key drivers you see pushing the uranium market forward in the, let's say, next 12 to 24 months? Are there specific events or developments you are anticipating?
I think that besides term contracting, which is the obvious answer, I think there are three factors that could drive price more. I think we could see more financial demand come in, especially if we clear that $90 level. And I think we could see a few of these financial entities enter. I think we could have spot see. I don't think they've played their final part in this bull market yet. Make of that as you will. I think it is going to become very, very interesting if more financial entities enter, because the market is relatively tight and they could have a monumental and outsized impact. But besides financial entity demand, which is not really accounted for in the demand side of the equation of these fuel reports, at least not as far as I've seen. Looking at it, I think we could also see some strategic stocking up of inventory of foreign nations. For example, the US. I wouldn't all be surprised to see the US, which, like, over the past few years, you see the US saying, okay, we need to be more energy independent, right? We have 20% of our energy grid being dependent on 99% imports. And 99% imports, that's not a joke. Like over the past 3 years, we've seen the US produce a grand total of 200,000, 50, and 680,000 pounds, making for a grand total of 930,000 pounds being produced over the past 3 years. That is, of course, ramping up right now, with producing less than 1 million pounds while you're consuming roughly 15 million pounds of natural uranium on an annual basis for such a critical piece of energy infrastructure in your country at a time of geopolitical turmoil and not necessarily very great supply chains. I think that's a risk. And I think at that point, we're going to need to see something of a strategic reserve to make sure that that critical piece of energy infrastructure can keep going, even if supply may not be available in the very near term, if we get to that point.
Yeah.
Lastly, lastly, circling back to that long-term vision for utilities, I wouldn't at all be surprised to see these US utilities in particular, but also other utilities around the world, look at that same geopolitical turmoil, that same supply chain turmoil, and say, okay, you know what we need? We perhaps need 3-year inventories, maybe 4, maybe 5, maybe more. That is all speculation at this point. But that mindset change is also, I believe, going to be paired with these longer term, more numerous inventories, so that they have something to fall back on. Because looking at it right now, like their nuclear power generated electricity is trading at a premium. They have a lot of customers going in, not just the public, but also these tech giants going in and saying, okay, we need to make sure that our at premium trading electricity is going to stay online whatever happens, because they're making money hand over fist at these electricity prices. And these utility stocks have done very, very well, and they've done a great job on that front. And I think that will continue as this renaissance continues. And I think that they will be more and more focused on making sure they get that security of operation.
Again, good point. Mart, the WNA fuel report forecasted a significant increase in the uranium demand by 2030 and beyond, of course. How confident are you in these projections, and what factors could either accelerate or derail this demand growth? And actually, what's your take on the report? Are there any surprises, if I may call it?
I first of all want to say that I thought it was a great report by the WNA. They did an exceptional job, as they always do. They put in a lot of hard work from a lot of different people from across the industry. And looking at the report, it was very, very interesting. I thought it was interesting that the fuel report itself, it had a monumental shift compared to the 2023 report. So if you look at the reference case scenario from this fuel report for the projected capacity, or projected nuclear capacity going forward into 2040, it went up by 60 gigawatts. The reference scenario itself went up by 60 gigawatts over the past 2 years in that reference scenario. 60 gigawatts is absolutely incredible. If you run it at, and this is an oversimplification, but bear with me here, at a 500,000 pound per gigawatt worth of uranium consumption, of course, that is subject to tails assays and to a bunch of other different metrics, but going with 500,000 for easy math, that is 30 million pounds of additional uranium on an annual basis if those 60 gigawatts do hit the grid of consumption. And 30 million pounds that we need. In essence, in 2 years, they just added another arrow worth of demand. We need another arrow, and the first one hasn't even been built yet. So I think that makes for very interesting reading. Looking at SMRs and the role we play, I think like SMRs, that's something that we will get into the discussion as well. So I'm gonna pulling that question forward. That is also taken into account. You have 3 different scenarios in the nuclear fuel report of the WNA. You have the lower, reference, and uppercase. The lower case accounts for 10 gigawatts of SMR capacity going into the 2040s or into 2040 itself. The reference case is 49 gigawatts. The uppercase is 110 gigawatts. Do I think we will reach that? And to answer your question a little bit more simply, do I think we will reach these nuclear power goals in general? I don't know. I've grown relatively wary, especially in the West, when it comes to these nuclear fuel predictions, because in the West we are very, very good at talking a big game, but now we need to walk it. Like China is building a lot of reactors. Other countries in the East are building a lot of reactors. The West really needs to focus less on talking a big game and really going out there and saying, okay, if we want to win this AI race, which is basically a modern day space race, and if we want to make sure that we have adequate power supply going forward, we want this 92.5% capacity factor green power to also meet our climate goals, we are going to not only need to talk about nuclear power, we're going to need to build it. We're going to need to have adequate political and monetary support to really get this underway. So do I think they will reach that? I think there is right now enough incentive to reach it. I think they can reach it. But I will still be relatively conservative in my projections because I've been disappointed before, and I've been speaking to several industry veterans. I believe it's safe to call them that. And they were all saying we had a few false dawns when it comes to a nuclear power renaissance. This feels like the last chance. We need to get it now. We need to make sure that it's good, and we need to make sure that we actually get this renaissance properly underway and get it properly supported. And if we can reach that, of course, like this was all not projected when I first started investing in uranium. And if you would have told me 5 years ago in 2020 that these would be the projections, I would have called you a liar and I would have asked you what you were smoking. But right now, once we're in the middle of it, it is already ridiculously positive. We don't need these enormous projections for the price of uranium to go up, but it would be great for those projections to be reached. And I am hopeful that it might, but I'm still relatively conservative in my modeling until the industry proves me wrong.
Yeah, however, we have the problem with the supply side. The primary uranium production has been lagging behind the reactor requirements. My question to you, what are the biggest challenges you see producers in ramping up supply to meet the future demand?
Besides timelines, because timelines are important, I mentioned this before, but at the when the fuel report was shown, they also added a little tidbit that they changed in their modeling. They changed the expected development timelines of new uranium production, primary uranium supply going forward, from 8 to 15 years, what it used to be before, to now 10 to 20 years. So they are very, very aware that these mines may not just come online on time and on budget. They may come online later than you would expect. Again, going back to what I discussed with the fuel manager, that paper coverage is not the same as coverage in your reactor core. Or on site if you have inventory, of course. But besides that, what I think is very, very interesting going forward for that coverage is that we, besides higher prices for longer and that time frame that is needed, I think we're gonna need a lot more intellectual capital. Like a lot of these people that used to know how to build and then importantly operate uranium mines as well. Like the herd has been thinned a lot since the last bull market. A lot of these guys have either gone on to greener pastures, working in industries that didn't go through a grueling 10 to 15 year bear market. They either retired because these were experienced folks, or they're just simply not around anymore. And there are only a few handfuls of management teams left that really know how to build and subsequently operate a uranium mine. So I think that intellectual capital is going to be the biggest bottleneck. I think there too that higher prices will resolve that bottleneck as well. I think we will see some consolidation of management teams that actually know how to deliver, get more assets under their wing so they can develop those simultaneously. But again, like I cannot stress this enough, and I know that I sound like a Dutch broken record right now, but honestly, we need a higher price for longer, and I think that's exactly what we're going to get.
Agreed. Let's jump on the secondary supplies like ex-military material or stockpiles. They have historically supplemented uranium supply. How significant are those sources today? How do you see them going forward?
I think secondary supplies are a lot less significant today. Of course, there are secondary supplies. There always will be some secondary supplies, but compared to the last bull market when we had the megatons and megawatts program pumping tens of millions of pounds, I believe it was 20 to 22 million pounds a year, pumping it into the market, reliable, cheap supply, getting into the market, saturating that secondary supply side of the equation. We of course had inventories, but over the past few years we've seen, I call it supply handles before, we've seen a lot of these utilities kind of pull these handles, like pulling forward Russian supply, importing Chinese EUP. I'm just pretending to get these handles for mental notes. Inventory drawdowns, flexing up of legacy contracts, where if you had for example, 22% flex option on a $45 base escalated contract, you're not going to sign a new contract at $70 per pound. You're going to flex up. Also drawing down of mobile inventory as well. And I think all of those inventories, like a lot of these levers have been pulled. They cannot be pulled again the way that they used to be. And the fact that UXC also know that the age of secondary supply is over. And the fact that I last year also spoke to a nuclear fuel buyer that noted that secondary supply was a source that was always seemed to be available from somewhere. There always seemed to be more secondary supply that was just available. But what he noted last year is that secondary source of supply now appears to have dried up, which I thought was very, very significant as a quote from him. And looking at it right now is that these secondary sources, of course, there are always sources, there will always be sources, as I literally just mentioned, but it's a lot less significant, and that really makes for the shock breakers that were present in this market in the form of that secondary supply, in the form of inventory, in the form of several other factors, I thought was significant to be utilized as shock breakers. And right now, if we see more shocks, these shock breakers, they are not present at anywhere near the capacity that they used to be. So these shocks will have a more profound and lasting effect on the market going forward. And yeah, I think that secondary supplies will have a role to play. I certainly take them into account, but they are far less prevalent than they used to be.
Yeah, the part of the interview usually my guests hate, and that is price projections. What's your outlook for uranium prices over the next, let's say, 5 years or even more, considering the supply constraints and a rising demand? Are there any specific price levels you are targeting or expecting? And I'm talking both long-term and spot.
I would say right now, I'm expecting, as I noted earlier in our discussion, that we first need to get through this $80 to $90 level. And once we get through that level, and how long will it take? A month, 3 months, could be 6 months, could well be 6 months. Once we get through that, however, I think that we will hit a sort of like a supply-demand air pocket where we could see price move up more substantially. So where do I think we will end the year? I think we could end it at $90, but I think we need to be a little bit more patient for that. Depending on how much demand, of course, comes in, we could get there very quickly depending on prevailing circumstances on the demand side, not just from utilities, but also from financial entities. But I think next year, if we have this conversation again in December of 2026, I personally think we will be talking about triple-digit uranium price in the term and spot price. And after that, like I will stay with my view that we will need higher price for longer. If we see a spike tomorrow to $110, that will be all nice and well. It will be great for our investment, but it will be enough to at least shake loose a little bit of supply. But it will not be enough to really get all the supply online over a long enough time frame to adequately fill that supply-demand gap. So I think that we need a stair-step way upwards. I've seen some very, very smart analysts that I respect a lot and are very plugged in call for $140 to $150 before this entire thing is over. I've seen some people quote 200 plus. Of course, like I'm not at this point going with those projections. I'm going to take it one step at a time and adjust my portfolio and my investments accordingly. But I think as we go up in this stair-step way, I think we have a long way to go. I think we will absolutely reach triple-digit uranium over the coming 12 to 18 months. And going forward, I think it will be a very constructive bull market. And in between, because like it is, even though it is stair-step ways up, like uranium equities will remain volatile. We've of course seen a lot of volatility this year. And I think that volatility, if you capture it well, will really have, it will make for a lot of good opportunities. So for example, during the April-May lows, we bought a lot of call options in chemical and energy fuels. Those chemical call options went up 350%. Those energy fuels call options went up 1157%.
Congrats on that, by the way.
Thank you, my friend. It was absolutely great, and it's great to see the community do well. And these are the sort of turns that I try to identify using sentiment analysis, using the fundamental analysis, and also using just trying to capture the price trajectory, trying to see where the turn is. And I hope to capture more of those opportunities because the volatility in this sector is both a blessing and a curse. So as we make our way up to that $100 level and beyond, that triple digit level that is so coveted, I think we'll see a lot more volatility. And I think that when you get the right information and when you get the right analysis, I think you can really capture a lot of upsides trading around your core portfolio as this thesis just continues to build.
This is a great piece of advice for investors, the old investors and the new one in the sector, on how to navigate the uranium market cycle. Mart, how can people reach out to you and become your subscribers?
They can go to patreon.com/Contrarian Codex, where I upload bi-weekly newsletters, usually 40, 50 plus pages. I do regular interviews, I do company analysis, and I also do incremental updates, sometimes 3 times a week, sometimes once a week, because I also cover macro. Because even though people don't really like to talk about macro because it can be a boring subject and pretty long of tooth, in the end it does affect all our investments. And I think that it is very, very important to follow, and that's why I really added it to my newsletters as well. And beyond that, I also cover various other commodities. Gold and silver have done exceptionally well in our portfolio, and I think that gold in particular will continue to do well going forward, again on that fundamental basis. And overall, yeah, I hope people join so they can be part of the community, and I will continue to work as hard as I possibly can to hopefully get more winners into the portfolio and hopefully bring the best information I can.
Yeah, Mart is one of those guys that I really respect the most in the industry. Great interview as always. Sorry, Mart Wolbert, aka Yellow Bull, thank you very much for these insights. We really learned a lot.
Thank you for having me, and I hope the listeners have a good and healthy rest of their day.